Are you struggling to find deals in today's market that pencil, that make sense, that cash flow that you can actually make money in? This is one of the biggest objections, problems that I hear from my students in the deal room, from people I talk to who want to buy real estate. And it's a real big problem. We had really inflated prices in 21, 22, and sellers really haven't gotten reasonable. Plus, the cost of debt is extremely more expensive than it used to be. You could get loans at 2.75, 3, 3.5. Anything under 4 was phenomenal. Now rates are 6.5, 6.75, sometimes even over 7%. So your cost of capital is doubling, which is hurting the pricing of what you can pay for multifamily or commercial. And yet sellers aren't really reflecting that. They're not willing to come down. And so if you're out there beating your head against the wall, trying to find deals that work, find deals that pencil, that can cash flow, that you can make money on, and that are safe, and you're not coming up with a whole lot of results, I've got a strategy that I'm going to share with you right now that's going to help you do more deals, bring less cash to the table, make better returns, and do it in a more profitable manner so that you can transact in these type of environments. Because when rates come back down, or if they come back down, you're also going to be able to get lucky. But how can you position yourself so that today you're in a deal that works, and in the future, if market conditions go your way, you have the ability to capitalize on that. So, I'm going to break down a couple of case studies of deals that I'm working on right now in real time, and I'm going to help you understand the model of what I'm trying to explain. Okay? So, imagine you've got a deal on the market, right? Let's just say it's $1 million triple net deal, and it's collecting $5,000 a month in rent. I'm going to use triple net just so that we don't have to factor expenses. Let's just say at the end of the day, you're netting $5,000 a month in real, income, and the seller, or your tenant, is paying all your expenses, your taxes, your insurance, your maintenance, all that stuff. Okay. So let me break down $1 million deal. Let's say you got $1 million deal, $5,000 a month is bringing in, and you want to get a loan. So you go to the bank and you say, "Hey, I want to borrow $1 million," and they say, "Okay, the rate's 6.5%. We'll give you a 25-year AM. Your monthly payment is going to be $6,752 a month." Does that deal work? You're only collecting five. So unless you want to bring 1,700 a month to the deal, it's not going to work. Plus, the bank is never going to loan you that amount of money because they know the deal doesn't cash flow. So they say, well, you're gonna have to bring some money to the table. Okay, I'll bring 200 grand. I'll bring 20% down. So loan me 800 grand. Okay, now your loan payment is $5,400 a month. You're getting close because you're bringing in 5,000 a month, but your debt service coverage ratio is still like a 1% DSCR. They're not going to do that. You've got to be at 1.25, meaning you've got to collect 125% of your loan payment. So if we drop that loan balance down to $600,000, now your loan payment's about $4,000 a month. You're bringing in $5,000 a month. You're hitting your 1.25 debt service coverage ratio, and they're going to do that deal. The problem is you're now tying up $400,000 of your cash, right, to buy that deal, and you're only cash flowing $1,000 a month, right? So $12,000 a year. Maybe you're getting some debt pay down, or you are getting some debt pay down, but if you've got to split that up between four guys who threw in 100 grand each, that deal gets really, really skinny really, really fast. So what do you do? Well, you're going to look at that deal and you're going to say, "Ah, man, it's too expensive. I can't pay that. Like this really, if I could get this deal for like six or 700,000, it would make sense. I could get a good loan. I could put down 10, 20%, and I could make profits for my investors and carve off some for myself. And I could do this deal." And so you make your offer to the seller of six or $700,000, and they say a big fat no. And you think, well, the prices are just too high, sellers are unreasonable, I just can't get a deal. And all your excuses sound best to those that make them, right? Because you're not getting a deal. You're not making anything happen. You're not buying property. You're not controlling anything. And so you're in no better shape than you were. And I'm going to tell you, the thing that is constraining you is not necessarily the price. We all look at like, okay, this property's $1 million. This is 2 million, 5 million, 10 million. That's the constraint, is the price. And I'm not going to tell you that price doesn't matter, or price per square foot doesn't matter. But a bigger constraint is your cost of capital. So, what do I mean by your cost of capital? Well, one, you've got the opportunity cost of your down payment and other things you could be doing with that money. You could be earning money in the stock market. You could be earning money in the money market. You could be earning money by buying other deals that are maybe better. So, there's definitely an opportunity cost there. You're also looking at the cost of the capital of the whoever's loaning you the money, right? Whether that be the bank, private money lender, the seller, whatever, there's a cost to that capital. And my argument is really that is your biggest constraint. And I'm talking just pure math, right? I'm not talking about some of the other risk factors that go into these things like delinquency, vacancy, maintenance, repairs, et cetera. And that's why I'm talking about triple net leases here with an underlying good tenant in a good location. That's probably the only uh, way that I would recommend this is in very good locations with very steady income and great tenants, because some of these numbers are going to get tight. So follow along with me if you can, because what if I told you that you could borrow $1 million at 3%, right? 3% amortized over 25 years for the same $1 million deal. Well, now your payment is $47.42 a month. Okay, so you're only making $250 a month in cash flow. Wow. But remember, you're getting $1 million worth of capital at 3%. And so you don't have to put any cash down. And also remember, you're amortizing $2,400 a month, right? That's going to be about what, $27,000, $28,000 of debt pay down every year. Plus, those rents are escalating by 2 to 3% per year. If you've got a commercial lease, that's typically written into the lease that the payments go up by 3% a year. So if your payment is $5,000 year one, then that payment is going up by $150 a month every year, which is another, $2,000, which is increasing your cash flow to 4 or 5 grand a year plus your pay down. And every year your pay down gets greater as that principal balance gets lower. And so, for the sake of argument, I would say this deal you could do. If you could get $1 million at 3%, you could do this deal. If you could get $1 million at 1% or at, no interest and just principal pay down only, absolutely, because now you're going $5,000 a month into the good and it's going completely against principal. And as long as that tenant is there and that tenant keeps paying and you have some reserves so that if that tenant defaults that you can get a new tenant in there, that deal is going to work because your cost of capital is so low. Now, you may be listening and saying, okay, Jennings, that's great. I understand, but who's going to loan me $1 million at 100% leverage at 3% for 5 or 10 or 15 or 20 years? And the answer is probably nobody, right? And so how do we utilize this strategy? How do we lower our cost of capital to control deals in the real world and with real life examples where it actually works? So let me give you a scenario. And I want you to think about this not in terms of price, but in cost of capital. Okay, so I'm under contract on a deal right now in James Island. Okay, we've signed the PSA, we're in the due diligence period, we've got all the financials, we're going through it, and we should be closing. What's today? May 28th. We should be closing by the end of June, beginning of July on this deal. Okay, so the seller has this thing listed for $2,050,000, right? And so he's collecting about $11,000 a month in rent right now. It's a triple net lease. It's a credit tenant. It's a private equity firm that has 78 medical offices. And so they're probably going to pay. And I've looked at the underlying financials on the dental practice as well as the private equity. Private equity is making many millions of dollars per year. And even the sole dental office is very profitable. So I believe that they are a credit worthy tenant. I think they can continue to pay $11,000 a month. And they've got a 10-year lease with 3% escalations built in, 2 5-year extension options. So they want to be there for a long, long, long time. And so I'm looking at this deal, and remember, you know, if $1 million at 6.5% is, 67.42 a month, $2 million is going to be, 13 $1,300 a month, $1,400 a month, $14,000 a month, and he's only collecting 11. Like, that doesn't make sense. I'm gonna have to bring a lot of cash, like 40 to 50% cash, just to be able to, have a loan that meets that DSCR requirement, which is pretty important in the banking industry. So what do I do here? Because I like the deal. I think the rents are going to continue to go up. I think the property is very valuable. It's in a great area of Charleston, South Carolina, growing market. So how do I do this deal? Well, I run the numbers. I think, well, if I was going to buy this straight up, I would need to pay about 1.65 million. The bank will loan me about 1.3. I can put 350 into it in cash. Over 5, 6, 7 years, the rents are going to go up, and this will be worth, maybe 2.3, $2.4 million, and I can make a good return on the 350 that I've tied up, and I can make a profit for taking the ride and taking the risk. That's where I need to transact if I'm going to do this on a traditional deal. And so you can imagine, as the seller looking at my offer, you're asking $2,050,000, and he gets an offer for $400,000 less, 25, almost 25% less than what he wants. Is he going to be excited about that offer? Probably not. But with the way rates are right now and the way the debt markets are, that's where the deal pencils for me. So that's where I need to be at. So am I going to make that offer? Yes, I still am. Absolutely, I'm going to make that offer because I don't know what's going on behind the scenes. Maybe he's distressed. Maybe he really needs the cash. Maybe he just wants to be done with it. Maybe he wants to sell, and I don't know. But I also made a corresponding offer, like two offers. I made the cash offer, 1.65 million straight up. We get a bank loan, we buy it, we're done. Or option two, which was I'm going to get a loan for $1.3 million. You're going to loan me $500,000, Mr. Seller, and I'm going to bring $100,000 in cash. So the total purchase price will be 1.9. Now I'm very close. I'm within 5% or 6% of what he's asking. Like, that's a pretty strong offer. He's going to pay attention to that. At closing, he's going to get 1.3 million in cash, and he's going to get a seller note at 4% interest only for 5 years. After 5 years, the balloon payment is due, and I got to pay him off the 5 million by either selling the property or refinancing the property. Okay, so he doesn't get all his money up front, but he does get his 1.9 eventually, and he gets 4% interest on 500 grand for 5 years. So he's paying attention to this. He likes it, and he does eventually accept this deal once he figures out that I am credit worthy and I'm going to pay him back. So let's look at the math on that, right? So I'm borrowing 1.3, and I talked to my banker, explained the scenario to him, and he's like, okay, well, yeah, we can do this, but we really need to get you down to a 6% rate for this deal to pencil and get the DSCR. So I ended up doing a rate buy down. I bought the rate down to 6% from 6.75. That cost me about 35 grand, but he was able to roll it into the loan. So now my loan balance is 1.335 million. Okay. My payment to the seller is only $1,666 a month. So I'm going to just double check my math here. So I'm telling you guys right. 500 grand times 0.04 divided by 12. Yeah, 1,666 a month. And then my mortgage payment on this is $8,601 a month. So $8,600 a month is my mortgage payment. My payment to the seller is $1,666. So my total payment is about $10,267 a month. And I'm collecting $11,000. And every year that payment goes up by 3%. So it goes up by like $350, $400 per month. Right? So my cash flow continues to improve. The first couple years is going to be somewhat tight, but we're going to get there. I'm also so free cash flow. I'm free cash flowing about $750 a month out the gate, going up by $300 to $400 a month every year. As we progress. So I'm about $9,000 $10,000 in the good on my cash flow per year. I'm also amortizing about $24,000 per year in debt pay down, right? So now my positive, return on my 100 grand is about 34, 33, $32,000 per year. So if you're making $32,000 on 100 grand, I mean, that's a 30 something percent return. That's pretty good because that debt pay down is real. So yeah, maybe I'm paying a little bit more, but I'm able to not have to bring 500, $600,000 in a down payment to this deal. I'm able to owner finance my down payment at a really attractive rate, 4% interest only, fixed for 5 years. I'm able to buy my rate down to 6%, so I get my mortgage payment to be pretty low because I'm going to hold this property long term. And all of a sudden, this deal works, right? It's a good place for me to park my capital. I can accrue a little bit of cash that I'm probably going to just keep in reserves in case something happens. But remember, the tenant is on the hook for everything, right? Other than the structure and the HVAC and the roof, they're on the hook for everything. Like they've got to maintain the parking lots, they got to maintain the exterior paint, interior paint, they got to fix the toilets, electrical problems. I mean, anything like that, maintenance related, they've got to pay for. They just replaced the roof 3 years ago. They just replaced the HVACs like last month. All the HVACs are new. The crawl space is encapsulated. This is a really, really, really good condition property. And so I'm willing to walk into that deal and do that because my cost of capital is low and I have a very small cost of like opportunity cost because I'm not tying up 500 grand to be able to buy this. On top of that, I don't have to split up the deal, right? I don't have to get 4 or 5 people to throw me 100 grand and pay them a preferred return and give them 50, 60, 70, 80% of the equity of my deal. I can keep all of that equity to myself, right? Or I can split it with one other partner. So it's the lion's share of the deal is going to me. And when we run the NOI in year 5 and we, sell that at a 6.5 cap rate with the rent escalations compounding, the property's worth 2.4 million. On top of that, our loan balance has dropped from 1.33 million to like 1.13 million. So it's gone down by 200 grand. And I still got to pay my seller. Well, my basis in the deal is going to be about 1.7, 1.75. So there's $600,000 there. 100,000 of it is mine. I'm just getting that back, my cash that I put in, but I'm still making a $500,000 on this deal. Now, am I making as much as if I had just bought it straight up for 1.65 million? No, I'm not. Or am I? Because if I don't have to give away 50, 60, 70, 80% of the deal to people that partnered with me to give me the 400 or 500 grand down payment, I probably would have only walked away with one or $200,000 anyway. So yes, I am making more money because my cost of capital to control this deal is so much lower. Now my risk, it is more elevated. That's something you got to consider in this equation. The guy that's the seller that's loaning me the $500,000, he's got a second mortgage on this deal. If I don't pay him, like he can foreclose on me, he can force my first position lien to call their note and it could get real ugly, right? So if he leaves or quits paying me, like the dental office defaults, right? I still have, about a $10,000 a month monthly nut to cover, plus my taxes and insurance, because all that stuff's gonna be on me. And so I need to have 50, 60, $70,000 worth of cash sitting around to make that turn to get a new tenant in there who's paying me. And it may take that long, may take even a little longer. So I've got to factor that in, that I've got to have staying power if something goes wrong. But I feel pretty good about this tenant. I feel pretty confident that they have the ability to repay and that they will repay and that they're going to be a good tenant for me. So by lowering my cost of capital, I'm able to still do that deal and I can walk away with, four or $500,000 profit over 5 years. So would you invest 100 grand to make, $100,000 a year over 5 years? I mean, I would. That's why I'm doing the deal, because I've lowered my cost of capital. So I was able to pay within 5% of the asking price on this deal, still get the deal, and make a 30% return on my cash in the deal, and make, 500 grand over the life of the loan or life of the deal. And that's, if I don't hold it, I could refinance him out at that point and keep the deal. So we'll look at that, because if I did that, I just have to get a loan of 1.7, 1.8, and get him out completely, and then keep on, paying down that debt, and keep on holding it. So I'm doing the same exact thing on a 57 unit apartment complex. Uh, a colleague of mine brought this deal to me. He had it under contract for 9.1 million, and he's managed it for 7 years, knows it inside and out, knows the expenses, and looking through the pro forma and walking the property and looking at how much cash was going to be needed, because we'd have to bring about $4.5 million in cash to this deal, because there was a Fannie Mae loan in place and low leverage. And so we just needed a lot of cash to do the deal. And I'm looking at, man, to attract investors to this deal, you kind of have to double people's money in 5 or 6 years to get people to come into a deal. To do that, we're going to have to exit this at a really high exit price. And I just don't know, like, if rates are going to drop that far. Like, I know there's a value add. I know we can get the NOI up, but like, I don't feel comfortable doing this deal at 9.1. And I told him that. And I underwrote the deal myself, and I came up with a figure of about 7.3 million. That's where I was going to transact straight up, where we could assume the loan, we could give her the balance in cash, and we could take over the deal 100%. And my partner said, look, she's never going to go for that. She wants 9.1. Like, that's her price, and she's not going to do 7.3. I said, okay, well, then I can't do this deal. It just doesn't make sense. And so we went back to the drawing board, and I went back to like cost of capital. Like, how can we lower our cost of capital? Because we've got a huge slug of equity, $4.5 million that we need to put into this deal to make it work. And the structure we came up with, I'm not going to belabor every detail, but essentially we went to the seller and said, look, if you want 9.1, this is how we can get you to 9.1. You may not like it, but if you don't, we can transact at 7.3 straight up and be done with it. But if you want 9.1, you need to hold $4 million in owner carry at 4% for 6 years. Now, when your loan matures and we refinance you, like, you'll be off the loan, and we'll give you $1.5 million of the 4 we owe you. And then when we sell it in year 6, we'll give you the balance of the 2.5 that's left, and you can get your full 9.1 plus your 4% interest for 6 years. And that's kind of our offer. And she thought about it, and she kind of pushed back and said, hey, if I'm going to do this with you guys, I want an equity split. I want to get a piece of the upside as well. And we thought, okay, well, we can conservatively sell this for 10.2 million in 6 years. We know we can hit those numbers. We know we can sell it for that. And that will get our investors a double on their 500 grand that we're only have to put into the deal. Because remember, the down payment was 4.5. Now it's only gonna be 500 grand for us. So we got to give them a double on that. And then we want to make about 800,000. So we need to, net about 1.3 million ish on the deal. We can make 800,000. Our investors can make 500,000. They can get their 500K back, and that's how we're going to structure this. And so we said, once we hit that hurdle, like once our investors make their double and we make our profit, anything beyond that, we'll split with you, because we may get lucky, right? Rates may come down. We may be able to sell it for 11 million, 12 million, 13 million. I mean, who knows what the market's going to do in the future? But it gives her a guaranteed buy of 9.1. She's going to get her 4 million. She's going to get her interest on that. And if we do really, really well, and after we've made our profits, then she's going to share in the upside of that. And so that's where we are with that deal. We'll see if she accepts or doesn't accept. And if she doesn't accept, it's okay, because I'm not going to do a deal that is going to not get the returns that I want for my investors. Whereas if I know that my investors are only making, putting 500K in, and we're going to be making $1.3 million, and I can give them 500K back plus 500K of profits, and I can still make 800,000, that's going to be a good deal for me. And so beyond that, I'll share the wealth with her, and she's okay with that, or we'll see if she's okay with that. But by lowering my cost of capital, this deal really works, and it actually cash flows better than if I went out and got new debt and had to pay a preferred return to my investors. And so the cash flow, because the underlying loan is so good, it's 3.8%, Fannie Mae. I mean, it's a great underlying loan. Like, the deal cash flows really, really well and is a safe deal for us to walk into. So when you're looking at a deal that seems maybe overpriced, look at, how could I make this work and how could I get close to the seller's purchase price? Now, some sellers, they're totally bonkers. They want way too much, double what it's worth. But if you underwrite a deal and you're within 20, 30% of where they want to be, think about, how can I lower my cost of capital? Mostly from my investors. Will the seller carry a promissory note? Will the seller do a pref equity place in the syndication where maybe they're ahead of the investors, but they're going to get their purchase price, but they have no upside on the deal other than their interest rate, and then negotiate that interest rate as low as you can. I like to look at a deal like, if I can break even, cover my debt, pay the seller from day one, and it's only going to get better as I work my plan, as the rents increase, then that seems like something that I can entertain. So there's a lot more to it. If you want a copy of my deal analyzer that has all this seller financing modeling built into that, seller second, seller carrybacks, all that stuff, shoot me a DM on Instagram or Facebook, and I'll send it to you for free. Just say, hey, I want the course, and I'll send you my analyzer, an 8-video course on how to use it, and it can get you started with seeing opportunities that are right in front of you that you may not know are there because your cost of capital is too high, but you can lower it. All right, guys, have a great week. Talk to you soon. Peace.